The big talking point in the last 36 to 48 hours has been this record 2.1 trillion rupees dividend that the Reserve Bank of India has given to the government. Now, various theories around how this has come and what it could be used. The HSBC note by Pranjul Bhandari speaks about this was largely led by higher interest earned on FX reserves and higher foreign exchange sales. He joins in right now to talk about the how and why of this and the what of this as well. Pranjul, great having you. Thanks so much for joining in. As always, of course, we'll talk a bit more than just the topic. But let's start off with the topic. Did the numbers surprise you, or did you part anticipate this?
Well, I think, we had a sense that it'll be a high number, perhaps a little more than what was budgeted, but, not as high as 2 trillion. So part surprise, yes, higher than expected.
Okay, well, how a lot of people guesstimating as to how did the RBI manage to pull off this number? Any thoughts on that? I think your note speaks about it, but lovely to hear from you.
Yeah, sure. Look, first the caveats, which is that, by the end of June, we will have the RBI annual report, and then we'll know exactly from where this money came. But until we have that, let's speculate. I think one important area was the fact that the RBI was earning much higher interests on its foreign currency assets simply because interest rates around the world have increased, right? You're getting more interest on your Fed bonds, BOJ, Eurozone bonds, and so on and so forth. So higher interest rates environment. The second was the sales of FX reserves that the RBI did through the year. Through the year, it sold about $153 billion of FX reserves. Now, it buys at a certain price, it sells at another price, and the wedge is the profit margin, and it made a hefty margin on that. So I think both of these were very important drivers of the profit. There were other areas as well, but I think these were the predominant ones. And if you take a step back, both of these are driven by global factors. Interest rates globally are high, and because of dollar volatility, the RBI was selling dollars to keep the rupee stable. So both of them, in some sense, were driven by global factors. One question that I'm getting from everybody is this number sustainable, right? Or is it just a one-time bounty that we've got? My sense is that some of it is sustainable, some of it could be one time. So I would be sort of comfortable saying that about half of it, 1 trillion, could be something that continues, at least over the next 1 to 2 years, even though we don't get all the way to 2 trillion. At some point, if the global interest rate environment changes, if central banks around the world start cutting rates, then this RBI dividend would come off a little bit. And also this purchase price minus sale price, which was the profit which the RBI made on its FX sales. At some point, that basket could change and the profitability in that could actually fall a little bit. So my sense is, it could be a little lower going ahead, but higher than it was about 5 years ago.
So then I have a two-part question. One, for the here and now, let's say for the next 12 months or until the next dividend season comes in and we know what's happening with the tax collections, etc. How does this place the government, how favorably does this place the government finances, both from a fiscal glide path perspective as well as from the capex perspective?
Yeah, so this has definitely provided degrees of freedom in fiscal financing. Right? When we had the interim budget in February, the government was talking about 0.3% of GDP worth of RBI dividends. It's turned out to be about 0.6. So it's turned out to be about double of what the government was expecting. So this incremental 0.3% of GDP is the bounty that the government has received. Now, how will the government use it? I think there are two things it can do. It can either save it or it can spend it. If it saves this amount, it would basically mean that it brings down the fiscal deficit and basically cuts down on market borrowing. And this is something that would make the bond market very happy because the supply-demand dynamic in government borrowing will improve. And I think that's something that has added to a lot of excitement over the last 48 hours, right? The second thing that the government could do is spend this extra 0.3% of GDP. Then the question arises, where would it spend it? The options here are more capex or more current expenditure. Now, I have some views here. We've had this government being very focused on capex over the last couple of years, but the truth is you can't suddenly increase capex in a major way. because to increase capex, you need implementation capacity on the ground. So it's not just about throwing money, right? So my sense is that it may not be able to put a lot of this extra into capex. It has already budgeted a 17% increase in the capex budget this year. It might be hard to increase it further at such short notice. Instead, my sense is that if the government wants to spend it, it could rather spend it on current expenditure. And there is a case to be made here. We know that if you look at the economy right now, consumption, particularly mass consumption, has been slightly on the weaker side. If you look at government finances for FY25, the provisions for some of the social welfare schemes, for some of the centrally sponsored schemes, have been actually lower, about 0.6% of GDP lower in FY25 compared to the previous year. So there is a case that can be made for replenishing some of these schemes. And my sense is that, perhaps that is where the government will focus to add a little more to current expenditure, to welfare spending, because this extra, money has gotten available. So there are the two options: save or spend. It could actually even do a bit of both. Half of it can be saved, so you cut borrowing a little bit. Half of it could be spent, so you increase social welfare spending a little bit. But either way, it's got cash to work with, and this is a great situation to be in.
Yeah, good problem to have. And in fact, you're so right on the capex front. I remember post the interim budget, the government went to lengths to explain that they've not gone ahead and matched the percentage number, because the economy needs to have the capacity to be able to absorb such large capex spend as well. So that's well pointed out. Pranjul, I'm just wondering, the yields, I mean, yes, there has been some excitement, but have they come off to the extent that something like this would normally entail, or is there something else on the minds of the market? Maybe the kind of demand supply that it currently exists, unless the government announces something else.
Well, if you're talking about has there been like a big rally in the last 48 hours, I think the rally obviously has been extremely, yesterday in the equity markets. Generally, it's yesterday the bond market was shut, right? So there are many moving parts here, right? There's a lot that is not known. It's not known where this dividend will be spent or whether it will be saved. So I think that is one sort of question mark. The other question mark is whether this is sustainable or was it just a one-off. That's also something people are thinking about. People are also waiting and watching on what the election results, throw up. So there are many sort of moving parts. It's not just one thing that would determine, an entire market. But I think on the margin, the news is good. And we might actually see more implications in bond prices a little later, when in June we start seeing this JP Morgan index inclusion money starting to flow in. Then some of the gains could be more visible at that point.
Okay, so that plus JP Morgan could make June a potent month for bonds, you would reckon, Pranjul. Okay, a point well noted. I believe that's what you were trying to refer, right?
Yes, I think so. Like I think that we will start seeing a lot of the impact in June, particularly after elections. Yeah.
Got it. Pranjul, just one quick follow-up before I move on to other aspects as well, and which is, for the last 6 months, we've seen some aspects of the rural balance sheet, rural household, being stronger, not by virtue of just the agri income, but the non-agri income piece as well. And if that is indeed been the case, it's a bit befuddling as to why is it that rural consumption still hurts so much for such a prolonged period of time. Is there some kind of the way it happens that is it difficult to comprehend, and is it difficult to comprehend as to when this will change, and will it need government spending for it to change, or could there be a cyclical turnaround as well?
The problem is that the major activity in rural India is still agriculture. Things like construction are actually secondary activities in rural India. And what we've seen is that agriculture has gotten hurt in the last couple of years with a series of climate change events, right? We've seen rainfall becoming far more erratic, floods, droughts, heat waves, unseasonal rains, everything one after the other. It's like shock after shock. Today we worry about rice, tomorrow we worry about vegetables, day after we worry about pulses, but there's something always to worry about. And I think this is sort of a problem that we are facing, and this is a problem that is going to stay with us. Climate change is not going anywhere. So in a situation like that, we'll have to think about some longer term policy to help rural demand. We are lucky right now that construction has taken off, And in my sense that, around the second half of 2023, construction activity really took off. That's around the time when we knew that the Kharif crop hasn't been very good because of it being a El Nino year. And we found a lot of rural Indians moving to construction sites, doing a lot of construction work and sending money back home. We can see that data. We see that in the Aadhaar enabled payment system, remittances from urban back to rural India. So thankfully, that became one sort of a cushion at a time when, agriculture production was a bit weak. We also see this in the Jandhan account cash balances. So the cash balances started to pick up. So I think on the margin, the news was good because construction became a new avenue for rural Indians. But the truth is that perhaps rural Indians would want to see these cash balances rise a little more before they start spending because they have dissaved a lot over the last couple of years in the pandemic period and then El Nino and all of that. So perhaps they are waiting to build up their cash balances a little more before they start spending in a big way, if they ever do. Also, they have actually started to spend also, if you look at a certain indicators like two-wheeler sales. There was a Nielsen survey on retail sales. Rural India has, finally started to pick up. A couple of other data, that I track. There has been some uptick in rural spending, but you're right. It's not in a major way. It's a little better than a quarter before, but it's not back to pre-pandemic levels.
Okay. So Pranjul, that being said, therefore, let me just shift focus. I mean, viewers just remember on the RBI dividend, Pranjul and her note says that we will know all the answers when the government presents its budget in July. Until then, hold your breath. So that's part one. She's given her possible or some probabilities, but let's wait till July. So that is done. Now, Pranjul, can I just shift a little bit to growth and inflation dynamics on the back of this rural piece that we spoke about as well? India is growing well. Can growth moderate or will growth continue to be as it has been? And can consumption coming back, if the government supports some bit of it through this RBI bonanza and spends something in current expenditure, let's say rural consumption, etc., can that help growth further?
Yeah, these are great questions, and there are many moving parts. My sense is that we are going to be in a regime of robust and stable growth, not accelerating growth, neither falling growth. So my sense is we are a 6.5% growth economy, and I think that is going to continue over the next year. Of course, there are error bands. It could be slightly higher, slightly lower, but I would say, a midpoint of about 6.5% growth. Now, few things that could cease to be a growth driver are there. For example, commodity prices fell a lot last year, and that was in terms of trade benefit for us, right? Cost of production for manufacturers fell. The manufacturers were able to make higher profit margins, and that was a source of growth. But now, because commodity prices are not really falling, if anything, they are sort of stabilized, my sense is growth bounty from there would be a little limited. Another area where, we are not sure where the growth bounty would be is this whole exports of professional services. This exports of professional services has taken off in a big way. And in the last 3 years, my estimate is that they've added about 1 percentage points to India's GDP growth. But, it can't continue to grow at the same clip every single year. And if it consolidates a little bit from here, then the growth addition from that source may not be as high as we've seen in the last 1 or 2 years. So some growth sources could actually peter off or soften. But on the other hand, my sense is that some other growth sources will remain in the system, and one of them is construction. Now, a lot of the projects which the government has been sponsoring in terms of infrastructure or private sector has been sponsoring in terms of real estate, many of them are multi-year projects, right? They're 2 to 3 year projects. And once they start, they stay in the system for a while. And my sense is that will actually continue, over the next year. It could also even increase over the next year. So my sense is, that's something that could continue. And if you are lucky, then hopefully after the election results are known and then there's stability, we might see some private investment also come up. There are some interesting investment intentions data I track, which shows a lot of investment in futuristic sectors could come through. So if that comes in, that could be a new source of growth. So some sources will go away, some will stay on, and some new sources will come. And overall, my sense is that GDP growth will remain at these levels of about 6.5% over the next year.
And viewers, for you to know what are the new sectors that Pranjul is talking about, we've done an extensive conversation on that some time back. You might want to go and revisit that. Pranjul, I have one more question though, and which is intriguing that, typically for a growth economy and a country which is growing, it tends to spike inflation a little bit. We are not quite seeing that, if I can call it a correlation between growth and inflation being as strong as typically you would have been used to see. What's happening here? Have you looked at this? Any thoughts on this?
Yeah, that's a great question. In the past, the joke was that if India grows at 6.5%, then core inflation is also 6.5%. And if India's growth rises to 7%, core inflation is also 7%. So when growth rises, core inflation rises. Core inflation is, non-food, non-fuel inflation. So the inflation that is the underlying inflation of the economy. And a lot of times it's driven by growth. So higher growth, higher core inflation. This is perhaps the first time in recent memory that I'm actually seeing growth so high, at about 6.5%, but core inflation actually falling. Over the last year, it has fallen from 6.5% to under 5% at this point of time. So that's sort of like an interesting development out there. And I think there are some important drivers of this. Number one, commodity prices. As I had mentioned, they fell last year. So when they fell last year, we actually found a situation in which a lot of producers, because input prices had fallen, they were able to reduce output prices to some extent. So therefore, core inflation came down. That was one. The second is an interesting one, which is Chinese disinflation. Now, if you look at export prices in China, they have been falling. There has been a huge amount of disinflation in the economy. And if you look at export volumes of China, they are rising. So China is selling a lot to the rest of the world, but at a lower price because they are seeing disinflation. India has imported some of this disinflation, in my view. India imports a lot of goods from China. That is no secret. And through that channel, it has actually been able to import some of the Chinese disinflation. So I think that's been a second driver. And the third driver, which a lot of people don't which appreciate but is very important, is the hawkish RBI. This is an RBI which has doubled down in its commentary on the fact that it wants to reach 4% inflation target. Inflation has already fallen from 6.5% to 5%. Instead of patting itself on the back and saying it's been a job well done, it's saying no, a lot of the job is still left to be done. And when a RBI continues to talk hawkish, then what it does is it brings down inflation expectations in the system. And that in itself becomes a driver of disinflation. So a hawkish RBI has also helped keeping core inflation low at a time when growth has been rising. So this is a very interesting new paradigm, right? The central bank actually strongly being a driver of disinflation. And I think we are good to have that with us, because if your inflation is low, your fiscal deficit is falling, then you have macro stability, which means that GDP growth can be high for a longer period of time.
Without inflation worries coming back and biting for sure. Yep. Let's see whether the Q2 numbers on inflation drive the Reserve Bank of India to maybe take some rate actions. But we'll save this question for later. Pranjul, I've already taken more than 15 minutes of your time, so I understand you have to go. So we'll let you go on that note. But thank you so much for taking the time out and being with us today and explaining to us predominantly these mechanics around this RBI transfer and some more. Really appreciate it.
My pleasure. Thank you very much for having me.
And the pleasure was ours. Viewers, thanks for tuning in.